Good afternoon, everyone. My name is Brian Cohen. I'm a partner here at Jameson & Company, and I'd like to thank everyone for attending today's webinar. Today we're going to cover DCAA compliant accounting system requirements for SBIR awardees. We're going to get a little bit straight off the topic a little bit, meaning we will discuss some other award or funding vehicles that are outside the SBIR program. We won't get into too much depth, but we will cover vehicles, like I said, that are outside the SBIR program. Today's agenda, we'll start, give you a little bit of background about Jameson & Company, who we are, what we do. We won't talk about services. We can talk about that later if there's time. We'll then get into the compliance, and we'll talk about compliance on a number of levels. We'll talk about levels. We'll talk about compliance at the contract level or the funding vehicle level. We'll talk about it at the agency level, and then we'll actually get into the accounting system compliance requirements. And we'll talk about certain aspects of accounting systems and get into a little bit more depth in each one of those. Next, we'll cover types of government audits. We'll talk about DCAA audits, audits from NIH, National Institutes of Health, and then we'll have a question and answer session. I anticipate the webinar itself, or my 1 through 3 here, will cover about 40-45 minutes, and then we'll have a 10 to 20 minute Q&A session. So to start, who is Jameson & Company? So Jameson & Company has been around since 1978. We're I would consider ourselves a boutique or niche accounting firm. We're located 10-15 miles northwest of Boston, Massachusetts. And over the course of the history of the firm, we've helped government contractors and grantees across the entire U.S. Procure, manage, and survive audit on more than $4 billion in government contracts and grants. Our senior level account managers and partners have 20+ years of experience. That isn't all with government contractors, but we've all come from traditional public accounting backgrounds and or have some government contractor experience, so in the private sector. We have clients in 33 states. They have funding from a number of agencies, almost all government agencies, and they have a number of different types of awards: cost reimbursable, time and materials, firm fixed price, you name it, we've seen it. This is a little bit, we say we've got 30 clients in 33 states. We do have a client that has a barter award in the UK. So we have one international client now, which is something new for us. So when we talk about Jameson & Company and what we do, I said we're a niche or boutique firm. So we specialize in working with government contractors and grantees. So in a traditional CPA firm, there are really 2 types of accountants. There's tax accountants, and there's GAAP accountants, or what we would consider CPAs. So in order to make a comparison of, and show you the difference between what we do and what traditional CPAs do, we liken the areas of expertise, accounting expertise, to various languages. So a tax accountant is very well versed and is an expert in the Internal Revenue Code. So we liken that language, that specific understanding the Internal Revenue Code and being able to speak to that and about it, we liken that to Spanish. For purposes of government contracting and grant accounting, Spanish is irrelevant. We can speak it. Sometimes we need to be able to speak it here at Jameson & Company if we're looking at a client's tax situation, but for purposes of this, it will say it's irrelevant. Now, GAAP accounting, generally accepted accounting principles, we liken that to French, and it is extremely extremely relevant to what we do. Now, from a government accounting and grant accounting perspective, we deal in the Federal Acquisition Regulations, or the FAR. You'll hear it, that's the acronym that you'll hear commonly here. We liken that to Greek. So in order to speak Greek, we need to be able to speak French. So there's a very close connection, or if there's a foundation, GAAP is the foundation of the FAR, so we need to understand French in order to speak Greek. So why would you need a compliant accounting system? Well, if you have a contract, an existing contract, or if you're in the midst of receiving a contract, especially a DoD contract, look closely at it. There are a number of Federal Acquisition Regulation clauses included in those contracts. If you see FAR clause 52.216-7, that's the allowable costs and payment clause, FAR. And what that says is you've got to have a compliant accounting system, and we'll talk about that later. But what it really means is you need to account for your costs, demonstrate to the government what your costs were, and then there's a true-up mechanism that occurs on an annual basis. And we'll talk about that in a couple of slides. But this clause is incredibly important and is what's going to determine whether you need to have the compliant accounting system that we're going to be talking about. If you're an NIH grantee, in your grant, your notice of award, there will be a link to the grant policy statement, which is on NIH's website. So in that grant policy statement, there's reference to, not specifically to FAR 52.216-7, but there's reference to maintaining, the requirements of an accounting system, the reporting requirements, the annual true-up report that we'll speak about. So if you have a notice of award from any agency in any contract vehicle, if there are links to underlying terms and conditions or policy statements, please be sure to read those. There's a lot of information in there. They are often overlooked, and we find that a lot of grantees and contractors get themselves in trouble because they don't take the time to read them, and if they do read them, oftentimes they don't understand the details in the actual requirements that are included there. So again, if you get, make sure you read all the terms and conditions. If you don't understand them, engage a professional. So when do you really need an accountant that speaks Greek or is fluent in the FAR, the Federal Acquisition Regulations? It's really when you have a cost type award. So what does that mean? Well, a cost type award is one where you are allowed to bill the government for your actual direct costs, so your project costs. And then you can get reimbursed an additional amount on top of that, which is to cover your indirect costs or your overhead costs. If you have a firm fixed price contract or award, and that's the only type of funding vehicle you have, then you don't necessarily need someone or an accountant who can speak Greek. So what types of awards are cost type awards? All SBIR, STTR phase 2s. NIH phase 1s are cost reimbursable awards. So that's kind of the exception to this. You won't get a negotiated rate with a phase 1. However, you're still going to be required, you still should have a compliant accounting system where you can segregate job costs on an NIH phase 1. ARPA-E awards, that's the Advanced Research Projects Agency, Energy. So that's under the Department of Energy. RO1s, those are under NIH. Broad BAAs, broad area announcements, and BARDA awards, which are, BARDA falls under Health and Human Services, HHS. So what these awards include, like I said, it's you're either going to see FAR 52216-7, or you're going to have terms and conditions included in the notice of award that explain to you your compliance requirements. So these cost type rewards, like I just said a minute ago, you're allowed to bill the government for direct costs. And in addition to that, some percentage of direct costs to cover your overhead. So in order to capture your direct costs appropriately, you need to have an accounting system that allows you to segregate those costs in order to, by project. You also need to be able to segregate your direct, indirect, and unallowable costs, okay? Now, what FAR 52216-7 says is that at the end of every fiscal year, within 180 days, you are required to complete what's called an incurred cost submission, or some people refer to it as a true-up report or a rate package. Okay, so what that does is at the beginning of your award, a contractor or grantee negotiates and agrees with the federal government a certain indirect rate that they can bill the government at over the course of the year. They agree up front. It's an estimate, and it's negotiated. So the contractor grantee bills the government at this rate. Let's say it's 50% of direct labor on the contract or grant. So they're billing. At the end of the year, because this is a cost type award and the government's only going to reimburse you for your actual cost, you then need to do an accounting of your actual indirect costs. That true up report, incurred cost submission, rate package, goes by a number of different names, demonstrates what the company's actual costs are. Then there's a billing adjustment that's required if the actual rate differs from the agreed upon estimated rate, which is also referred to as a provisional rate. So in my example, if you agreed up front with the government that you're going to bill them at 50% of direct labor, and your actual costs, indirect costs, were 40% of indirect labor, you've overbilled the government by 10 percentage points. So you need to credit that money or return that money to the government. If your actual indirect rate was 60% of direct labor, you've actually incurred more cost than you estimated. The FAR allows you to bill that differential if you'd like. You don't have to, but you do have, in theory, you have the right to bill that because it's a cost reimbursable award. These are your actual costs, okay? So that's really what the FAR 52216-7 speaks to. It talks about allowable costs, actual costs, how to do the requirement to do the incurred cost submission, how you bill it or credit it back to the government. But in order to do this detailed level of accounting, you need to have a compliant accounting system. So what are some of the requirements of the accounting system? Well, first, you have to maintain a GAAP, or generally accepted accounting principles, GAAP set of books. Okay, and we went back in one of the first slides. I had said that GAAP is the foundation of the FAR. So everything is based on GAAP. Furthermore, in your general ledger, you need to be able to segregate your direct costs from your indirect costs from your unallowable costs. Okay. Now, another aspect of this that the system must have is job costing. and it doesn't say it here, but that is another critical component. So when you start looking at your general ledger, not only do you need to be able to segregate your direct costs from your other types of costs, but you need to be able to do it on a project-by-project basis. So if you have one contract, you should have a job cost report for that contract. If you have two contracts, you should have a job cost report for each of those contracts with the various direct costs segregated appropriately by contract. Your indirect costs, things like rent, utilities, fringe benefits, etc., those will go into your indirect rate. So we need to be able to segregate those out. And unallowable costs are very, this is another part of the FAR. FAR Part 31 speaks specifically to what cost the government is willing to pay for it and is not willing to pay for it. And we have a lot of companies come to us that don't understand allowable versus unallowable costs. And you can get yourself in a lot of trouble, a lot of financial trouble with the government if you end up billing an unallowable cost to the government and they end up paying it. So an unallowable cost you could try to bill it direct, you could try to bill it indirect through your indirect rate. So you have to be very careful, and you have to have an accounting system that takes those unallowable costs and segregates them from your allowable, your direct and indirect, so that there's no risk of billing those to the government. Now, what's an unallowable cost? It's something like a bad debt, charitable contributions, interest expense on debt. Excuse me. When you step back and you look at FAR Part 31 in its entirety, I think the way that I like to, or I describe it to clients is, you really have to ask one question: does this cost benefit the government? If the answer is yes, then we can go a little bit deeper to see whether it's allowable or not. If the answer is, the answer to the first question is no, it doesn't benefit the government, then it's an unallowable cost. So a lot of people have asked, will make the point of, well, interest expense doesn't make sense to me. It's a cost of doing business. Why won't the government pay for it? Well, if you step back and think, well, you ask the question, does the government benefit from it? Yes, they do benefit from it because the government, you need the financing in order to run the business. However, the government really doesn't care how you finance your company. They've given you funding in the form of a contract or grant, so they expect you to use that, and they've given you a reasonable overhead rate or indirect rate to cover the cost of doing business. So they're not going to finance, excuse me, any debt. Another common unallowable cost is the cost to raise capital. That's strictly prohibited and unallowable. Okay. So we oftentimes get questions about what's the most widely used government accounting system used by government contractors, and there's no real good answer. What I would say is it's dependent upon your size, and oftentimes you don't look at how big you are today. You look at where you're going in the next 3 to 5 years. So QuickBooks, most of our clients use QuickBooks. It's the most, I think 97, 98% of all small businesses are using QuickBooks. So QuickBooks, you can make QuickBooks with some tweaks to it compliant with the federal acquisition regulations. You can segregate your chart of accounts appropriately between direct, indirect, and unallowable. It does have a job costing component to it. It's very limited, but with some additional tools, it works, and it works completely. It works fine, and then we've got hundreds and hundreds of QuickBooks accounting systems through DCAA audit for our clients. So we're very comfortable with QuickBooks. But like I said, there are some tweaks and tools that need to be made to it in order to make it compliant. But that's the most common one we see used is QuickBooks. So, you know, there's compliant accounting systems, and then there's rules within your contract. There's accounting compliance requirements, and then there's obviously different sets of government rules. So at a high level, GAAP is the foundation, like I said a number of times, of government accounting rules. It's kind of the backbone. So underlying everything, if you think of this, if this were, you know, a pyramid, it's kind of inverted, but GAAP would be the foundation. Then you work into the federal acquisition regulations and the cost accounting standards, and that's what we're talking about today. Then we kind of narrow it down even further, and you look at agency-specific rules. So who's the funding agency? That each agency oftentimes will have its own rules. So NIH, for example, does not consider independent research and development to be a indirect cost. They look at it as a separate project whose costs go in the denominator. They look at it as a direct cost. Department of Defense, on the other hand, looks at independent research and development as an indirect cost, and they're willing to reimburse you for that, where NIH won't. Narrow it down even further, you start looking at program-specific rules. ARPA-E under DOE has specific rules related to their program. SBIR has its own rules. So, for example, PI has to participate at least 51% in the grantee's business. Then it narrows even further into contract-specific rules. And here you're looking for things that are specifically called out in the contract. For example, there might be rate limitations or rate caps that say, an example of that is we'll agree that you can bill us up front at 50% of direct labor. However, if your actual costs are in excess of that, you can't bill us anything more than, say, 55% of direct labor. So if your actual costs end up being 60%, you can only bill up to the 55. So, you know, again, you have to read these awards and vehicles very closely, and if you don't understand it, you really need to get a professional involved. So those are some of the nuances with the government rules. So let's talk a little bit more about actual accounting systems. So one of the areas the most heavily scrutinized areas in any accounting system revolves around timesheets, time reporting. So what are the rules? Well, first let me lead into this by saying when we set up an accounting system, we set it up for the most stringent requirements, in our professional opinion. This is our opinion that DCAA, out of all government agencies, is one of the stricter agencies to work with. So we set the bar at that level. So for time reporting, first, timesheet should be filled out and inked daily. And I will say that applies to every employee. Oftentimes come across the fact that a CEO or president doesn't want to do timesheets. Everyone has to do a timesheet, no exceptions. You must record all time. I know we all work, in startups, you're usually working in excess of 40 hours, so you record all time. Timesheet must be signed by the employee. Must be signed by the supervisor indicating approval. Any changes to the timesheet need to be crossed out in ink, not erased, and the employee needs to initial it. And it's a good habit to have them explain why they made the change, okay? Now, what I just said and described, those are the criteria to have an acceptable timekeeping system. In today's day, and obviously, it implies that you're using manual timesheets and you're filling them out by hand. Today's day and age with technology, there are a number of electronic timekeeping products on the market. And if you're going out and evaluating those, and you know, to be perfectly honest with you, my advice would be if you have 1 to say 10 employees, I'd use that as a general guide. Manual timesheets might be the answer. However, if those employees are working remotely, it may not be. But once you start exceeding the 10, 12 head count for employees, you probably want to start looking at an electronic timekeeping system. Now, there's a number out there that will say they're DCAA compliant. You have to be careful with that because DCAA is not going around with their stamps giving electronic timekeeping systems their stamp of approval, DCAA stamp of approval. What that really means is the system meets these criteria. So there's a unique login for each employee. The employee submits their time on a daily basis. There's an electronic approval process by the supervisor. And any changes, there's an audit trail for changes by the employee, and the employee's got to initial the change. And typically, in most systems, they're going to put an explanation as to why they made the change, okay? Word of advice, if you're going to go out and look for an electronic timekeeping system, ask if it synchronizes with your accounting system. So there's a lot of there's quite a few timekeeping systems out there that will synchronize with QuickBooks, okay? And it makes the accounting a little bit easier. There's some setup, and it's you know, it takes a little time, but it can be done, and it will make your life easier. Another requirement is you must have a labor policy. And what we talk about here is that the policy, you know, first you have to describe the requirements of your timekeeping system, what we just went through. But it also needs to deal with what the term uncompensated overtime. So in order to explain this, I think I'm going to give you an example. So this goes back to the fact that startups, professionals, we're typically working more than 40 hours a week, and all of those hours need to be recorded on the timesheets and the time system. So when you bill the government, you're billing them on a cost reimbursable award. You're billing them at the actual cost. So if someone is making $80,000 a year, there's 2,000 hours in a year, the cost is $40 an hour. So if they work 100 hours, $4,000 that you're billing the government. That's the cost of the company. That's what you're billing the government if it's all direct on a project, okay? So what complicates it is if the person actually works 250 hours during the year, or, you know, let's break that down into, you know, even if it's on a pay period basis, they're working in excess of 40 hours. Well, $80,000 a year divided by 2,500 hours is $32. So the question is, what do I do with the differential between I'm paying them at 40, but because they're working in excess of 40 hours a week, it's only costing me, in theory, their effective rate is $32 an hour. Well, there's really 3 ways to deal with it, and you need to address this in your accounting policies and procedures. The first is you can pay the overtime. So you bill the government at $40 you actually bill them for the 2,500 hours at $40 an hour. So therefore you have the cash, you can pay the employees. You can change the billing rate every month. So instead of $40 an hour, the billing rate is going to fluctuate depending upon the number of hours the employee works each billing period or pay period. Adds a level of complexity to your accounting system, but maybe the simplest answer. And the third is, excuse me, you bill the employee at $40 an hour, and you track the excess amount that, so if you're not paying the overtime, you accrue it, and then at the end of the year, if finances allow, you pay the employee. If finances don't allow, that means, in essence, you bill the government at $40 an hour, but it's only cost you $32, and that's what's accumulated on your balance sheet as accrued payroll, it's accrued liability. And if the finances of the company don't allow for you to pay that, you end up crediting it back through your indirect rates. So what that means is you reduce your indirect expenses for the year, which lowers your indirect rate. And when you compare that to what your negotiated rate with the government, you're essentially crediting it back to them through your indirect rate. It's kind of, you know, and it's getting a little deep here, but that's the theory behind it. But the important thing here is that you need to be able to, you need to have a policy on this, and you need to have, your employees need to be educated, and they need to be trained on how to keep a timesheet. They need to understand how to report their time properly when they're working on, when they're working on Project A versus Project B, versus being indirect and working on something, for the company, whether it's a company meeting or training. So let me tell you a story about a client of ours that was an MIT professor. So the DCAA, this client had a number of Department of Defense awards. DCAA, the Defense Contract Audit Agency, is the audit arm of the Department of Defense. So they have the ability, and we'll mention this later, they have the ability to come in and do surprise checks at any time, unannounced. They show up at your facility, and they interview the employees, ask them what they're working on, ask them how they record their time, ask them to show them a current timesheet, make sure it's up to, they want us to make sure it's current and you're recording your time on a daily basis. So DCAA shows up at the client, unannounced. They come in, they ask for a register of employees, they start talking to employees, you get to one particular engineer and ask him what he's working on, and he says, well, when I'm working, I have this big pile and, devices in the middle of the table, and, I work on this and work on this. They said, well, how do you know how to charge your time? They said, well, excuse me, I will charge my time on a contract that I'm told to charge my time on, unless there's no more funding, and then I'll charge the other contract. So that's kind of a red flag that to the auditor that says, they don't have what they're really doing is working on Project A until the funds run out, and then when that happens, they're going to continue to work on it, but they're going to charge Project B. That's a huge no-no. So what ended up happening is DCAA left, went back to their office, and shut down all the funding for this particular contractor. They blackballed them. They didn't recover from it. The professor eventually ended up working for one of his PhD students, and I think he still works for him today. So sad, but that's the reality of working with the federal government, and shows the importance of having a compliant accounting system. And it's not just one or two people in an organization that need to be diligent. It needs to be passed through the organization It needs to be embedded in its culture. So what are some of the other direct costs that we typically see? Consultants. Oftentimes we see some consultants or contractors subbing out work, and so what do we need to have here in order to be compliant? Well, you need a consulting agreement that specifies what the hourly rate is and gives a detailed scope of the work the consultant's going to be doing. Then, as the work begins and proceeds, the consultant has to provide an invoice to the company, to the contractor, that details the number of hours and the work performed, shows the hourly rate, and extrapolates that into a total bill. Direct materials, you need to get an invoice from your vendors, your suppliers. All invoices need to be vouched or coded. So if you get an invoice for a direct cost, whether it's a consultant, material, subcontractor, travel, it needs to have annotated on it, if it's a direct cost, what project it pertains to, so you know which project to assign it to in your accounting system, and what type of cost it is. Is it materials, consultants, travel, subcontractors? So you can assign it to the proper general ledger account in your chart of accounts. Okay, that's your job costing. If it's an indirect cost, rent, utilities, fringe benefits, health insurance, those invoices also need to be vouched or coded. So you need to indicate which general ledger account it needs to go to, so that the accountant can, the bookkeeper or accountant knows where to assign it in the chart of accounts. And those costs, as I said, then go into your indirect rate calculation and determines how much you can actually bill the government for indirect or overhead costs. Direct travel, you really should be getting expense reports from employees. And again, if it's for a project, it needs to specify what project it was, the direct cost or travel costs pertain to, and it should be subject to per diem rates. So you can reimburse an employee for costs in excess of the government per diems, but that excess cost is unallowable. So all you can bill to the government is the cost up to the per diem rates. And you can find those per diem rates at this website here, defensetravel.dod.mil. And you go in, it's geographic, you select the area of the country you're traveling to, and it'll give you what you're allowed to bill, the caps you can bill to for, say, lodging, meals, etc., depending on the geographic location. Whoops. Subcontractors, let's see if we go back here. Oh, that's forward. Subcontractors, this is an area where we see a lot of companies get in trouble again. And what's required is that you have a signed subcontract agreement, and you need, because you're essentially flowing, this is a sub-awardee, a subcontractor is a sub-awardee, and you're just passing funds down to the sub-awardee. You need to make sure that you, what's called, flow down the proper contract provisions to that sub-awardee, because they're subject to them as well, okay? And I'm not going to get into the difference between a subcontractor and consultant in this conversation or this webinar, but there is a distinct difference, and it's, like I said, it's a little too deep for this, but just know that there is a difference. So this is an example of how contractors and grantees can get themselves in trouble. So I'm just going to read this. According to Wall Street Journal, Northwestern University agreed to pay nearly $3 million to settle claims that a former cancer researcher fraudulently used federal grant money for personal expenses, including food, hotels, airfare, between 2003 and 2010. The whistleblower, Melissa Tice, worked as a purchasing coordinator, processing invoices when she noticed some red flags, according to her attorney. The Federal False Claims Act allows private citizens who allege government programs are being defrauded to file actions on behalf of the government and receive a portion, usually 15 to 30% of any unrecovered damages. Ms. Tice reported this. Northwestern paid $3 million. She walked away with almost $500,000 in settlement proceeds for reporting it. So, you know, the moral here is this stuff is real. It happens. You need to be diligent about your accounting. You need to have people in your organization that understand the rules, who are well trained and well versed in the federal acquisition regulations, understanding allowable versus unallowable, and knowing when to ask questions and push back. Now we're going to talk about different types of audits. So Department of Defense, DCAA performs their audits. So they have accounting system reviews, pre-award audits. Pre-award audits are one of the simpler audits to pass, and those are performed before you receive a cost type or cost reimbursable award. So your first cost reimbursable award with the Department of Defense agency, they're going to do a pre-award audit. Make sure your system's compliant, can handle the accounting requirements. And if you don't pass this, you don't get the award. It's as simple as that. If you want the government's money, you have to play by their rules. Post-award audit, that can happen at any time after you receive a cost type award, unannounced. Government can come in. They'll usually, shouldn't say unannounced, it's usually typically unprovoked, I guess is a better word, but basically it's during the course of, you have a cost type award and they want to come in and ensure that your system has remained compliant. Surprise floor checks, we talked about that with the MIT professor. We hadn't seen those in, oh gosh, 5-6 years, starting to see them resurface. I had a client that went through one out in San Francisco 2 months ago. Provisional indirect rate submissions, that's the true-up report that I spoke of. So you agree to bill the government a certain rate. That's a negotiation. It's an estimate. At the end of the year, you have to submit an incurred cost submission that has a 100% chance of being audited. That's the audit. They're going to audit your rate submissions. There's billing audits now. Those are becoming more frequent. Well, I think we talk about that a little bit in the next slide or so. That's the DCAA will select a cost reimbursable voucher that you submit to them in order to get paid, and they'll audit it. And they'll want to see supporting documentation. And incurred cost audits. I'm sorry, I confused the two. The provisional indirect submission it's the document you submit to the federal government in order to negotiate your estimated billing rate. So that's with DCAA, you do that on an annual basis. So there's a negotiation that goes on for your billing rate. At the end of the year, you submit your incurred cost audit, the last one here, and that's the document that gets audited. It has a 100% chance of being audited. Okay, and that's the true up. That solidifies your actual indirect rates. So if you want to learn more about the different types of DCAA audits, go to our website. The link is here. Everyone will get these slides. This is a white paper. DoD contract audits. Audits, like I said, are performed by DCAA. They have branches all throughout the country. DCAA is paid by the government agency. So the audit needs to be requested by the government agency that is issuing the contract, and they're working for them. So if you have a DoD agency as your cognizant agency, and cognizant agency is the government agency that you are doing the most business with, the most work with. So if you're doing business or working with DoD as well as NIH, you look at the volume of business that you're doing with, volume of transactions you're doing with each of them. The one that has a greater volume is your cognizant agency. So DCAA, again, will do surprise floor checks. They show up at your facility. They're going to do your annual incurred cost audit, which is your true-up report, and they're going to go where the accounting records are located. So they're going to show up on site. They're going to want to look at invoices, vouchers, timesheets, payroll reports, et cetera. They're going to want to look at the accounting support. And then they're going to do accounting system audits. Again, they're going to go where the records are located. And then the voucher audits, they will show up for those as well. Those will be on site. The annual incurred cost audits. Up until a couple of years ago, all the incurred cost submissions were put into a pool and they were randomly selected, as far as we know, for audit. So a couple of years ago, the independent review panel recommended a more risk-based audit approach. So what DCAA does is they stratify the population between high risk and low risk. I have no idea what the criteria are for high risk versus low risk. It obviously has to do with, I imagine, size of contractor, volume of business, complexity of the cost structure, the rate structure, et cetera. But suffice it to say, the smaller contractors are typically low risk, and those audits are typically done remotely. So they're desk audits, if you will. The larger contractors or high-risk contractors are done in the field. So, like I said, we theorize that low-risk audits have to do with the size, number of awards, no prior audit findings, your build versus actual experience. The random progress billing audits, those are new. Probably they started 2 years ago. And what it is it's like it says here, it's effectively a mini audit of your accounting system. They're going to take the voucher you submitted to them to get reimbursed for your costs, and it's broken down by cost category, labor, materials, et cetera, et cetera. And they're going to ask you for support for the cost that was billed to them. So they're going to come out to your site. They're going to ask for invoices, copies of invoices. They're going to want to interview employees, ask them what they worked on during the period that was billed. They're going to want to show them, they ask them to show work product if they can. What were you working? Show me what you were working on to demonstrate that you were actually working on this project. And then one of the real interesting things that we found was when they start auditing the labor, they start with the timesheets. They go to the payroll journal, to the labor distribution, which is converting labor hours into dollars to get it into your accounting system correctly and allocated, assigned to the projects appropriately, to the job cost records, which is job cost reports, and then proof that the employee was actually paid. So if you're not using checks, which very, very, very few of us are these days, you need to show proof that it went to their bank account, which kind of really baffled us, because that's hard to do, but we were able to overcome that. So as you can see, these are pretty intrusive, invasive. Another story that we were actually involved with here we were engaged to provide some litigation support to these professors, unfortunately. But again, I'll read it. In 2014 indictment alleges 1 count of conspiracy, 7 counts of making false statements, and 21 counts of wire fraud, all in connection with the Small Business Innovation Research Program. According to the indictment, both men started Integrated Micro Sensors, Inc., a small business which applied for and received SBIR grants and contracts from NASA, National Science Foundation, Department of Energy, and United States Air Force. Officials said if convicted of the conspiracy, both face up to 5 years prison term, as well as another 5 years upon each conviction of making false statements. For the wire fraud charges, the men face up to 20 years for each conviction. All charges also carry a possible $250,000 fine. So unfortunately, the 2 University of Houston professors were convicted and sentenced to prison. So again, this isn't, you know, the government, if you're going to take their money, you have to play by their rules. And it's real. And these, you know, this is public knowledge when we're not disclosing anything that's confidential here. But it's very sad. Oftentimes companies are trying to do the right thing, to getting funds to perform research and development, to deal with something that's plaguing the community, but we make mistakes. So we talked about DCAA and DoD. Now we'll talk about NIH grantees. What type of audits can you see? We typically see, before you get a cost reimbursable NIH grant, there'll be a just-in-time process. It's really not, it's not heavily scrutinized, but there's the one aspect of this process that is a little bit more involved is if you have a negotiated rate, if you requested a negotiated rate with NIH, there is an audit that takes place. So what you need to provide is an indirect rate submission or a proposal, so demonstrating what your indirect costs are anticipated for the year as well as your direct. And that document does get audited similar to the incurred cost audit or provisional rate audit under DCAA. So that's if you request a negotiated rate. We'll talk about that in a minute. The other types of audits it's just subject to are uniform guidance audits, formerly known as OMBA 133. So if you expend greater than $750,000 in NIH funds, you have to have an independent audit by an audit by an independent CPA firm that you have to pay for. The grantee has to pay for it. It also applies, this requirement applies to DOE grants as well. Difference being DOE will typically let you pass the cost of the audit through as a direct cost. And then if you have a negotiated indirect rate with NIH, you're again subject to the annual incurred cost submission. And a negotiated, if you want to learn more about what strings may be attached to your NIH grant, DOE grant, feel free to go read the white paper that we have up on our website. So a negotiated indirect rate with NIH is a little bit different. DoD, if you have a cost reimbursable award with DoD, you're required to negotiate a rate. NIH and NSF have what are called safe rates. So as a grantee for NIH, if you propose an indirect rate that is 40% or less of total direct costs, there's no negotiation. NIH will give it to you. If you're working with NSF, their safe rate is 50% of direct labor. So if you request 50% or less of direct labor, that rate is granted. No need to do a rate proposal, no need to negotiate the rate, and no need to do the annual incurred cost submission. So a lot of costs eliminated. However, doesn't mean what you really need to do is do an indirect rate projection before you submit your proposal to determine what your estimated indirect rates are for the company. Because if you propose a rate that is lower than what you anticipate, your anticipated costs are, you're going to have cash flow problems. So if your anticipated rate is 50% and you're billing the government at 40, there's the 10 percentage point difference. How are you going to make that up? If you have VC money, if you have other investor, you have Series A, Series B, fine, perfect. If you don't, you're going to have cash flow problems. So there are safe rates that are available that you will not be audited. However, you have to be careful because it may not be enough money to fund your business and help you grow your business. These safe rates do not prohibit you from being subject to the UGA audit, the $750,000 limit. So one issue we find when clients take or grantees take the safe rate. So just because you take a safe rate doesn't mean you don't have to have a compliant accounting system. It doesn't mean that you don't have to monitor your indirect rates. So if you don't negotiate an indirect rate and it's greater than 40% in your actual rate, let's say you take the 40% rate, so you don't have to negotiate it, and your actual rate comes in at something greater than 40%, say 50, no problem. There's no audits, you're fine. You're going to do your FFR, you're going to base it upon your 40% rate. The NIH grant special will perform a cursory accounting system review. You're going to do your drawdowns of TMS at your 40% rate. And you're going to do your FFRs, like I said. So if your indirect rates are capped at 40% and your actual rate is greater than that, you're fine. It's not a problem. You've drawn down what you're allowed to. You can't draw down anymore. You're capped at 40%. The problem arises is if your actual indirect rate and actual spending is not 40%, and you're drawing down at 40%. So what that means is you're drawing down funds that you didn't incur costs for. So we refer to that as committing inadvertent fraud. You're defrauding the government because your actual costs are 30%, but you're billing them at 40%, and you're not truing that up. And a lot of grantees don't realize that you have to monitor your indirect rates to know where your actuals are vis-a-vis your provisional rates. So you commit that inadvertent fraud on the FFR on line 13, where you certify that by signing this report, I certify that it is true, complete, and accurate to the best of my knowledge. I am aware that any false, fictitious, or fraudulent information may subject me to criminal, civil, and administrative penalties. So if you have a safe rate and your actual rate is below that safe rate and you haven't adjusted your draws for the differential between the two, you've committed fraud by signing this. So another case here, Washington State University engineer professor with his brother and sister-in-law charged with defrauding the federal government about $8 million in research grants. They claim that the three of them collected about $8 million from the National Science Foundation, Department of Energy, DOT, and Department of Agriculture. And the U.S. attorney stated, as charged, the defendants took money intended to foster innovative research by small businesses and instead used for their own personal use. They were charged in federal court, wire fraud, lying to federal agencies, and transacting illicit funds. And the charges carry up to 30 years in prison and $1 million fine. This is still ongoing. When do you really need to be concerned? You need to ask yourself or your accounting department two questions. If the answer is no, then you need to be concerned. Can I have a job cost report? That's what you use to invoice the government. If they can't produce it, you have a problem. If they can, then the next question is, how are the indirect rates actually running? So that will tell you what the actual costs are versus what you're billing the government. If they can't produce that, you have a problem because you don't know if you're overbilling or underbilling the government. You don't know where your business stands. So how can we supplement your financial team? We help you with the indirect cost rate development, rate projections before proposals. We can negotiate indirect rates. We can help you set up your accounting system and train internal people, bookkeepers, provide periodic oversight. We can prepare incurred cost submissions, and we can represent contractors and grantees during audits. And I'm not going to spend a lot of time on this. What are some of the symptoms that you might need a professional like Jameson? You don't know what to use in the cost portion of your proposal for an indirect rate. If you have a 7% profit on your grants or contracts and you're not realizing 7%, your profit's actually much less. If you're having cash flow problems, might mean that your rates are your actual rate's not aligned with your provisional rate. If you're having problems getting paid by the government, that's a big problem. If you're concerned with signing the FFR, the pains and penalties of perjury. If you're concerned about your existing financial team, if you if you can't get the 2 questions answered about, can you show me a job cost report? Do you know how the actual rates are running? So I think at this time, we'll turn it over to questions. I know we did get some questions beforehand, and I tried to answer most of those through the course of the presentation, but if I haven't, then I'll try to answer them now.
Okay, so if you have any questions, we're a little low on time here. I'll probably just take a couple. And then if you have any questions after the fact that don't get answered, you can feel free to email me, Katie Crowley. It's just katie@jamisondca.com. I'll put a list together of questions that didn't get answered and email that out to the group afterwards along with the PowerPoint slide. So here's the first question. For uncompensated overtime, is it an option to just bill the government the actual rate rather than truing up at year end?
Yes, as long as you dilute the rate using the hours worked. If you dilute the salary by the hours worked, you can bill the actual rate. That's what she means by actual rate.
Okay. If anybody else has any questions, you can either raise your hand or write your question in the questions box. Okay. Do you know where the government states that every person must fill out a timesheet? Is it because that is required for indirect rate determination?
Yes, it's required primarily for the job costing, but for indirect or overhead, employees that are working indirect or overhead, then you've got to be able to demonstrate how you classify their time. Now, I have seen instances, we just think it's a good practice. I'm not sure if I can give you a citation within the FAR or even the grants policy statement for NIH where it says that everyone must keep a timesheet. However, what I will say is that if you don't keep a timesheet, all of that labor needs to be treated as in the denominator. It can't be treated as indirect, and you can't request reimbursement for that. It would essentially go in the denominator of your rate calculation and drag your indirect rate down. That would be the conservative way to treat it if I was doing an audit.
Okay, so if there are any other questions, go ahead and ask them. We probably have time for maybe one more, or you can raise your hand if you want to say anything. Do most small companies, whoa, hang on, the questions are moving on me. Do most small companies with between 10 and 20 employees have a full-time accountant? Can that be outsourced?
It's really dependent on the company. There's no, I guess, hard and fast rule, but it can be outsourced. Yes, it can be outsourced to a bookkeeper, whether it might be part-time, and as long as they're adequately trained and versed in the FAR, and we can, we certainly can assist with that. And we also we do have a number of clients that outsource their accounting to us.
Okay, if you go over your direct costs, are you able to bill them but reduce your indirect costs?
It depends. Depends on, again, I think the agency you're working with. But typically the cost reimbursable awards are fixed. There's a fixed amount, unless you can ask for a modification and request additional funding. They could say no. I mean, this is the worst they're going to say is no. But typically they're capped, and they'll say in advance that the max you can get is, say, 1.5 million. You are allowed to rebudget grants. There are rules related to that, and you can rebudget from indirect to direct, but not the other way. I can't rebudget from direct to indirect.
Okay.
Hopefully that answered the question.
Okay, so we're going to wrap it up now. So if anybody has any follow-up questions that they would like to ask, or if they have any questions about services or how we work with companies, again, feel free to email me at katie@jamisoncpa.com. You will all get an email from me following this within the next day or so with the PowerPoint slides and recording to this as well. So thank you again for coming, and that's it.
Thank you.